Smiling faces on Wall Street this morning, a day after America's biggest banks pledged billions to stabilise the mid-tier lender First Republic Bank and urged jittery investors not to panic. But by this morning, it was clear they weren't listening. Shares in First Republic tumbled 20% in early trading, despite the $30 billion lifeline announced just the night before, as persistent fears about the health of America's banking sector trumped all else, sending all three major stock markets into the red: the Dow, the Nasdaq and the S&P.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them.
That was the Treasury Secretary yesterday doing her best to convince senators and the public that all was well, a week after the little-known Silicon Valley Bank kicked off the current crisis by disclosing a massive hole in its balance sheet, sparking a run on the bank and forcing US authorities to step in and guarantee all deposits. But far from calming markets, another lender, Signature Bank, also failed. And then the jitters spread to Europe, where the troubled Swiss bank, Credit Suisse, welcomed an emergency lifeline from its central bank with open arms. At the heart of this current banking turmoil are rising interest rates and weaker regulation for mid-tier banks like Silicon Valley Bank that encouraged its executives to take ever greater risks. Now, Joe Biden said today he was determined to punish those executives who, in his words, are responsible for this mess. But that's unlikely to cut it for the markets, who look at those interest rates and fear there could be more pain to come.
The federal government has an obligation to protect the safety and soundness of our banking system, which is the cornerstone of our economy. Without a banking system, our economy will come crashing down. So we must do everything we can to protect our banking system and to prevent a cascade of bank failures.
That's what the American Central Bank, the Federal Reserve and the Treasury thought they had achieved by stepping in to rescue SVB, guaranteeing all deposits and opening an emergency fund for other banks who may need it. But you know you're in trouble when news that the banks have accessed that fund is itself spooking the markets. Witness the shares of other mid-tier lenders like Zions and Western Alliance banks also getting pummeled today. Just like the great financial crisis of 2008, politicians and regulators can bend over backwards to convince the world everything is okay. But the markets simply will not listen. If they're convinced, the bubble is yet to burst.
Well, I've been speaking to Mohammed El-Erian, Chief Economic Advisor at Allianz and President of Queen's College at the University of Cambridge. And I began by asking him about what lies behind this turmoil.
That is certainly a contributing factor, but it's mainly the way in which interest rates have risen. And really, the blame finger is being pointed more and more at the US Federal Reserve, the central banks. Imagine you're on a motorway and you're driving too fast and it's getting foggy, and you don't take your foot off the accelerator. And then you misjudge the road, and then you have to slam on the brakes. You will cause an accident on that motorway. And that's exactly what has happened. The Federal Reserve for too long kept financial conditions too loose, interest rates at zero, pumping in liquidity. Then it mischaracterized inflation as transitory for almost a year. And then when it finally recognized that we had a problem, it then embarked on one of the most front-loaded interest rate increases, literally like slamming on the brakes. And that caught certain institutions offside. So that has been a big contributing factor, but it is the fragile institutions, the ones that had their own problems, that were the first to experience significant issues.
Fundamentally, how confident can we be that we're not going to enter a new financial crisis?
So it depends what you define by financial crisis. If you define financial crisis be the 2008 variety, where the banks end up holding the same asset, which is then damaged, and then the whole system comes to a standstill, we're not going to have that. But what we're having now is people being concerned in the United States about their deposits. And just think, your own calculus. If you heard that a bank out there had issues and the depositors were having some doubt as to whether the deposit would be made whole, you will then move your deposit to the biggest banks, the banks that are viewed as too large to fail.
I mean, what you're talking about effectively is a run on smaller banks. And that could be contagious, couldn't it?
It could. I mean, we had this amazing situation that over $40 billion of deposits came out of this one bank, Silicon Valley Bank, in one day. That's an enormous amount. And why? Because a side effect of technology, of us being able to do online banking, is that you no longer have to stand in line to take your money out. You can do it very quickly. So yes, there is a risk of these deposits fleeing.
And where does this leave Britain? Because, I mean, our banks are relatively small.
So Britain dealt with the issue really well. When the UK part of the Silicon Valley Bank had issues, and there were concerns about deposits, the Treasury and the Bank of England moved very quickly to facilitate a purchase of that bank by a larger bank where there is no questions about its stability. Where we are exposed, and where the whole global economy is exposed, is that we're going to see banks probably increase their lending standards, become more cautious.
The OECD predictions are very bad for the British economy. You know, we are basically comparable to Russia, and that's about it in terms of advanced economies. I mean, why is that? And will this banking crisis, such as it is, make it worse?
Well, we're dealing with a set of issues. Not only are we dealing with inflation, not only are we dealing with a change in globalization. Let's not forget that the US-China tensions are changing the way the globe works. But of course, we are adjusting to Brexit. And we've had inconsistent policy making, especially out of the Treasury, as we all know. So these things have come together to accentuate a problem we've had for a while, which is low productivity. But the good news is I think people understand that we've got to focus on productivity, which means increasing the labor force, making it more productive, but also increasing investments.
Right, but from what you're saying about the banking sector and how credit's going to be harder, does that make our economy more vulnerable?
Unfortunately, what's happening in the US is not going to stay in the US. And we're not going to feel it in terms of bank runs, in terms of a banking crisis. That is not going to happen. But we will feel it in terms of tighter credit conditions.
Mohamed El-Erian, thank you very much indeed.
My pleasure. Thank you.